Let's continue our discussion on composition scheme. As we already heard that this scheme is a scheme applicable for small dealers who are growing. The government is encouraging them to come into GST, but the regular GST looks very cumbersome and it is compliance driven. So many people are hesitating to become part of that regular GST. So for all such people, we are giving a shortcut scheme. We are giving them small procedures, simplified law with small rates of taxes, and that is nothing but composition scheme. For a dealer to be eligible for composition scheme, first of all, section 10 subsection 1 is insisting that in the preceding year your aggregate turnover should not have been more than 75 lakhs. Okay, and for special category states, this limit has been fixed as 50 lakhs. And I told you that this 75 lakhs has been enhanced to 1 crore. Then further in the latest meeting, they have recommended it to be 1.5 crores. But you have to follow your study material, your revision test paper, and do it accordingly. So then we are saying that in this scheme you have an option to pay tax at small rates. So we have manufacturer, he will be paying CGST, SGST, 1%, that is effectively coming to 2%. And then we have restaurant will be paying 2.5, effectively 5%. And trader will be paying 0.5 plus 0.5, that is 1%. These are the rates which are given for the composition supplier. And there is again, it is recommended that even manufacturer, the rate for manufacturer shall be reduced from 2% to 1%. Because see, the government cannot discriminate between a manufacturer and a trader. When a trader is enjoying 1% in total, then why the manufacturer should suffer? We are, by putting a bigger rate, we are discouraging manufacturing. So they made it on par. That is what they recommended recently. Okay, so if a person is opting for composition scheme, he need not do any classification of goods irrespective of the goods. This percentage will apply for the turnover for each quarter. Okay, he will not be able to raise a tax invoice. He will be issuing a document called bill of supply. This composition supplier cannot take credit because we are not giving him credit. That's why we have reduced the rate for him. Then double benefits we cannot give. And the buyer who has bought the goods from the composition dealer, even he cannot take any credit. Okay, so in the preceding financial year, if your turnover was more than 75 lakhs, then you will not be eligible for this scheme in the current financial year. You have to keep checking like this. Then we are saying that you need to understand certain definitions, like what do you mean by turnover in the state, because GST is a state-centric registration, so you will be paying taxes in each state from where you are supplying goods. Okay, so turnover in the state is nothing but taxable supplies, exempt supplies, exports, interstate supplies, all this into R. However, this shall not include inward supply. If the composition dealer is liable to pay taxes on his inward supply, that will not be added in the turnover. And it shall not include taxes. Okay, that point also they have cleared. Turnover is an amount which is excluding taxes. Then aggregate turnover. Aggregate turnover is nothing but again exempt supply, taxable supply, interstate supply, excluding the taxes, excluding inward supply of all the persons having same PAN across India. So we know you can have multiple business verticals, you can have different businesses in different states, each branch is doing some different activity. So all put together we have to check and see all the entities with same PAN, what is the aggregate turnover. Okay, then we saw who are the people who are not eligible for this scheme. Okay, so there we have understood that people who are doing interstate supply, they are not eligible for the scheme because that is subject to IGST. This is a concept applicable for intrastate supplies. Then there is another point. A person who is supplier of service, he is also not eligible for composition scheme. Otherwise, I told you all the practicing CAs, all the service providers, they will try to jump into the scheme. This is not for them. This is for people who are manufacturer of goods, traders of goods, and only exception to service is restaurant service. Then we are saying you should What are the other things ineligibility wise? You should not be manufacturing notified goods like ice cream, pan masala, tobacco, and you should not be selling goods through e-commerce operator, web portal. These were the restrictions that we have seen, and you should not be selling goods which are not subject to GST. So I gave you the logic for all this. Now let's see what are the other points. So now option lapses. Section 10 subsection 3 is telling option will lapse. When will it lapse? Option will lapse. When will it lapse? So here you need to understand the lapse of option will happen if the aggregate turnover exceeds 75 lakhs during the year. See, last year your turnover was less than 75, so you opted for composition scheme at the beginning of the financial year. But during the year, the turnover had crossed 75 lakhs. So whenever your turnover is crossing 75 lakhs, it will lapse. Option will lapse. So what is this point? Section 10 subsection 3 is telling the benefit of composition scheme can be availed up to aggregate turnover of 75 lakhs in current financial year. Okay, this option shall lapse with effect from the day on which aggregate turnover exceeds 75 lakhs. So what we are writing here? We are saying that section 10 subsection 3, benefit of composition scheme can be availed up to the turnover of 75 lakhs. If turnover exceeds 75 lakhs from that date, the option shall lapse. The option shall lapse. You have to remember this point. Okay, so till the end of the financial year, you will not be able to continue with the compensation scheme. The day your turnover is crossing 75 lakhs, this option will lapse. So when we are discussing this concept, you should read it along with another point which is called withdrawal of application under composition scheme. So this point we will understand with the withdrawal of application under composition scheme. Okay, what point is this? See, at the beginning of the year, I did some analysis. I found the composition scheme to be better. Okay, then I had opted for it. But as I proceeded, I went into my year and started exploring my business. That time I realized that there are many customers who are placing order for interstate supply. There is a huge demand for my product and everybody is requesting that I should sell it across the country. I want to move the goods from one state to another state. But because I am a composition supplier, I have an ineligibility. The scheme says that you should not be doing interstate supply. But now I want to grow big. So I have changed my mind. I don't want to restrict to one state. I want to explore sales to other states. From here I want to do it to the other state. Then that time I should withdraw my application for composition scheme. I should file an intimation to the government saying that I am no more interested in composition scheme. This is one point. Take another case. Okay, let's say you're finding that e-commerce is really helpful for your product and you want to sell the goods through e-commerce. Then in that case again there is ineligibility. Being a composition supplier, you will not be able to do it. Or your turnover has crossed 75 lakhs. In all such cases, once you become ineligible for the scheme, you should make an application withdrawing that particular scheme. So what is this point? So here we are saying registered person, okay, who intends to withdraw from the composition scheme, shall file an application in GST CMP 04, okay, 04 before withdrawal. Before you withdraw, you should make an application, or or where option has lapsed. Option has lapsed. So first one is you voluntarily, before you violate the conditions of the composition scheme, you better make an application for withdrawal. So what is that point? Before accepting an interstate supply order, before doing an interstate supply, you yourself withdraw from composition scheme. Or where option has lapsed, you have violated the conditions, you were not supposed to sell through e-commerce, you were not supposed to do interstate supply, okay, because of which the option has lapsed, or your turnover has crossed 75 lakhs because of which option has lapsed. Then in that case, where option has lapsed due to non-compliance, of conditions, taxable person shall file, okay, an intimation, of withdrawal in GST 04 CMP, composition scheme, within 7 days, of disability, Okay, so whenever there is non-compliance of condition, either the turnover has crossed or you are doing something which you were not supposed to do, then in that case, before that event happens, you make an application for withdrawal of scheme. If the event has already happened, okay, you have violated some condition, then at least intimate it to the government using the same form within 7 days of the disability. Once that event has happened, you should be quick, you should inform them within 7 days. So that is what we are discussing. Now let's proceed further. Tax not to be collected. Okay, what point is this? Here we are insisting that because composition scheme is asking the supplier, you pay tax at small rate on your turnover. Okay, every quarter look at your turnover. On that turnover you pay some small tax. Okay, so now the question is, this small tax, am I supposed to collect it from the customer? Answer is no. You are not supposed to collect it from the customer. This is what section 10 subsection 4 is saying. The burden of this tax is directly on you. You should not take it from the customer. That is the reason, people like us and consumers, when we are buying the goods from a composition supplier, the price at which we buy is a lower price. The reason being, first of all, they have not levied tax. Second thing, if we buy from a regular supplier, he would levy tax at regular rates. Here we are buying it from a composition supplier who is not supposed to collect the taxes. But I am sure you must be thinking the price taken by that fellow will be inclusive of tax. Yes, maybe on the face of the bill of supply you will not find any tax amount, but the price which he has collected from you might include that small tax. But law says don't collect it from the customer. Okay, then why we are stressing that it should not be collected? Because we don't want to give input tax credit benefit to the buyer. So there could be a possibility, if you raise a bill of supply, you show tax amount on it, that fellow may try to claim input tax credit. So we don't want that to happen. So best thing is, don't take it from the customer at all. Don't show it on the bill of supply. Okay, then we know this, the biggest disadvantage of this scheme is ITC cannot be availed. So because of this, that ITC chain is breaking. So to some extent, cascading effect will happen. Okay, the supplier who is a composition supplier, he cannot take ITC on purchases done by him, and he cannot pass on the benefit of ITC to his buyer. If it's a B2B transaction, his buyer will not be able to take any ITC benefit. Okay, and government is okay with this because small rate of tax they are giving. Penal provisions. Okay, what is this penal provisions? See, sometimes a person is pretending to be eligible for composition scheme. He is not eligible. He is underbooking his turnover. He is trying to show that his turnover is less than 75 lakhs. He did some evasion. He is not accounting totally, or he was not supposed to do an interstate supply, but he did. He is not supposed to sell through e-commerce, but he did. So basically a person is doing some violation of the conditions. Okay, so such person, we should not leave him. You should take some penalty from him. So here this section is saying, 10 subsection 5 is saying, if a person, okay, if a person is what is 10.5 telling? Let me read it out for you. If the proper officer has reasons to believe that a taxable person has paid a tax under composition scheme despite not being eligible, he is not eligible at all, but he is pretending to be eligible, such person, in addition to any tax that may be payable by him under the any other provisions of this act, regular tax, anyways we have to take regular tax from him. See, he has pretended to be eligible. We gave him the composition scheme, but later on the department came to know about his ineligibility. Then in that case, we will take regular tax from him. We will not leave him there. Along with the regular tax, we will also take penalty, which is as per section 73 and 74. Okay, this is in the penalties chapter. So we will take penalty from him as per section 73 and 74. See, here we can further write, when we are discussing withdrawal of application, we can also further add to this cancellation of permission. How does the government cancel? Here cancellation of permission is for two reasons. You have withdrawn your application under composition scheme, or you were pretending to be eligible but the government realized that you are not eligible. In both the cases they have to cancel. In what is the difference? In the first case, voluntarily you have applied for cancellation. You are saying, sir, I am planning to do interstate supply, or my turnover has crossed 75 lakhs. I am not eligible for composition scheme. I am submitting this application to you. Don't give me composition scheme. When somebody voluntarily comes forward like that, you have to cancel his composition scheme. Or he has not voluntarily come forward. He has been doing fraud. He is pretending to be a composition supplier. Then in that case, the department has to cancel his composition scheme. So when the department has to cancel his composition scheme, what are the provisions? So here, proper officer has reasons to believe that taxable person was not eligible to composition scheme. Proper officer may cancel the permission. The permission for composition scheme will be cancelled after giving opportunity of being heard, and he will raise demand for differential tax plus interest plus penalty. How much and all we will study later. So what do you mean by differential tax? He was supposed to pay tax according to regular scheme, but he was under composition scheme for some period. Okay, by the time this application, this with the cancellation happens, there could be a possibility that person might have continued to pay tax in the composition scheme. So we have to calculate from which day he is not eligible, from which day regular scheme will apply. Then what is the tax according to regular scheme, what tax you have paid, the differential tax we have to take from the supplier. So this is cancellation of permission. So what did we understand? See, we are understanding multiple points here. First we saw option lapses. Okay, option lapses if you are not satisfying the conditions or the turnover cross 75 lakhs. Immediately it will lapse. You are supposed to inform. Okay, when you inform, we will cancel it for you. Like that we have understood. Then what are the other points? Composition scheme is not applicable for reverse charge mechanism. This is another important point. Let us understand what point it is. So next point is composition scheme not applicable for reverse charge mechanism. Okay, how do we know it is not applicable for reverse charge mechanism? You have to read section 10 subsection 1 to understand that. Okay, what is the language of 10 subsection 1? I'll just read it out for you, try to understand. 10 starts like this: notwithstanding anything contained in this act but subject to the provisions of 9.3 and 9.4. Okay, 10 subsection 1 starts like that. I'll repeat again. Notwithstanding anything contained in this act subject to the provisions of 9.3 and 9.4. What is the effect of this? Section 10 subsection 1, it is clearly telling notwithstanding the act subject to 9.3, 9.4. What is the reading of this? See, this composition scheme is an independent scheme. It overrides the regular law. What does it override in the regular law? Like point number 1, the regular supplier tax rates are different, high rates, but whereas composition scheme the rates are different. So if a person has opted for composition scheme, this rate will apply but not the regular rate. The regular supplier is taking input tax credit, but composition supplier, the section said you can't take credit. Okay, regular supplier will pay monthly taxes, will file monthly returns, but this scheme is saying you do it quarterly. So whatever we are listening in this scheme is overriding the regular provisions in terms of rate, in terms of value, in terms of filing of return, paying of taxes, input tax credit. It is overriding everything. This scheme is independent. It is not subject to what you are studying for the other people. However, this scheme is telling when it comes to 9394, 9394 will override 101. So here composition scheme overrides all the provisions of the act except 9394. What is the effect of this reading? There is a supplier, there is a receiver. Okay, this supplier is of 9.3 specified goods, specified services, and this receiver is a composition supplier, composition dealer. How? Let us understand. Agriculturalist has supplied cashew nuts to Mr. A, who is processing them, adding flavors to them, making some food item out of it and selling it. So, agriculturalist has supplied cashew nut to a composition dealer. The turnover of the composition dealer is less than the limit, 75 lakhs. Now, cashew nut, when it is supplied, how does this composition scheme work? In the hands of composition dealer, that cashew nut is a purchase. It is a raw material for them. Such purchase, 9.3 is telling the recipient has to pay tax on it and all the provisions of the act shall apply. Now, the composition dealer will get a doubt. On such inward supply, can I pay tax according to composition scheme, the rates which we have seen here? This doubt they will get. So, here we are saying, no, you cannot pay tax at the rates of composition scheme. In this case, 9.3 will apply at regular rates. You have to pay tax at regular rates. Cashew nut is falling under which category? Classify accordingly. Rate of tax you put accordingly. This is your inward supply. It is not your outward supply. This composition scheme which we are hearing is your outward supply, whereas this procurement which you did is your inward supply. So, this inward supply should be subject to tax at regular rates. 9.4. Unregistered dealer is supplying goods or services to a composition dealer. This composition dealer is a registered dealer. Only then 9.4 works. Then again 9(4) applies at regular rates. You have to find out what purchases you have done of goods or services from unregistered person. You have to do self-invoicing, you have to classify, you have to apply the correct rate. This is your inward supply. For your inward supply, composition scheme not applicable. Regular law applies. Regular law applies. But you know what is the sad point here? They are saying when it comes to debit side of your P&L account, look at your expenses, look at your purchases. If it belongs to 9394, on such inward supply, pay tax at regular rate. Now, immediate question the composition supplier has, will I get credit? Will I get input tax credit? I am ready to pay 9394, but will I get credit? Answer is no. Once you are a composition supplier, outrightly we have denied input tax credit for you. Okay, ITC cannot be availed. You cannot argue that 9394 I have paid taxes, please give me the benefit of ITC. See, whether you paid directly to the government or you might have paid to your supplier, he must have paid, whatever case it is, on your inward supply, you will not get input tax credit. So, no input tax credit. Never. On your P&L account, you might have paid taxes. You may not fall under 9394. Composition supplier purchased goods which do not come under 9394. The registered supplier has taken tax from you. No ITC. No, you bought from unregistered people. You have paid tax directly to the government. No ITC. Universally, you will not get the benefit of input tax credit. So, this point you should remember. Okay, then further if you see, there are some more points. Okay, and we don't want to miss on anything, so listen to it carefully. If you further refer, in this persons not eligible under section 10 subsection 2, we have not mentioned one point. That point I want to add now. One additional point we have to refer. Persons not eligible. Here we are just adding one additional point. Casual taxable person and non-resident dealer, supplier. Okay, not eligible for composition scheme. Not eligible for composition scheme. This point we have to add. Why they are not eligible? First of all, who is a casual taxable person? See, casual taxable person is a person who's not having fixed place of business in a state, but he is supplying goods. How? Now we have this industrial exhibition going on. Okay, when this industrial exhibition is going on, we find people who are suppliers from across the country. Somebody is coming from Kashmir, somebody coming from from Kolkata, Banaras. They are selling their own products here. For 40-45 days they are here in this exhibition. So now you will get one doubt. Whether that sale which is happening in exhibition, is that subject to taxes? Yes, my dear students, consumption is happening in lakhs and crores of rupees. So government has got special provisions to tax that exhibition. All those people who are not having fixed place of business in India, but they are participating in a trade fair or they are participating in an exhibition, they are supposed to inform the government. They have to take a registration as casual taxable person. They have to deposit advance tax. So many laws are there for such people. Okay, same as the case with non-resident person. This non-resident person, taxable person, he doesn't have place of business in India itself. The difference between casual taxable person and non-resident taxable person, what is the difference? Casual taxable person coming from India, Kashmir to Hyderabad. He has a fixed place in Kashmir, but in Hyderabad he has come for an exhibition. Non-resident taxable person, he has a fixed place in Australia and he has come to Taj Krishna to display his products. Okay, so he is not having any fixed place in India. Such people, there is a very high possibility that their turnover is not more than 75 lakhs. Okay, when their turnover is not more than 75 lakhs, they may try to seek this scheme. They may say, please give us compensation scheme. We are small people. We've come for an exhibition. Look at our numbers. So we are saying we can't afford to give you the scheme. Obviously, your turnover will be less than 75 lakhs. Here it is less. You are roaming everywhere. Okay, how can we give you the scheme? And look at the scheme. This scheme is saying quarterly compliance. You have come for 10-15 days for an exhibition. If we wait till the quarter, you will vanish. So how can this scheme apply for you people? So casual taxable person or a non-resident taxable person, for you the scheme is not there. If you are doing temporary activity, we cannot wait till the quarter end and tax you. So that's why we are saying the scheme is not there for such people. Okay, that is one important point. Then what are the other important points that you need to understand? Okay, first important point that you need to remember is certain special points. What are these special points? For a casual taxable person, what is the document that has to be used? Which document you will be using? You will be using a document which is a bill of supply. So you will be using a document which is bill of supply. You will not use invoice. Don't use invoice, rather use bill of supply. So coming to some of the procedural aspects of compensation scheme, the law is insisting that you need to do certain things. For example, the first thing that they are saying, a regular taxable person and the composition supplier both are in the market and they're doing supply. But how do we differentiate between them? How do we know who's a composition supplier? Because when I'm procuring goods, I have a purchase invoice with me. I may think I can take credit, or that clarity should be there. So here the lawmakers are saying, whenever a composition supplier is doing a supply, let him use a document called bill of supply. He should not be using tax invoice, he should be using a document called bill of supply. So in our invoice chapter, there is another chapter where we have to study what kind of invoices are to be used, etc. There we will see what you mean by bill of supply. But right now you remember one thing in your mind. Okay, bill of supply is a document which is to be used by a composition supplier. Second important point, they are insisting that you should mention the words bill of supply, the words composition supplier, you should be mentioning composition taxable person, further not eligible to collect taxes. See how the government is protecting the consumer. The consumer will not know about all this composition scheme, regular scheme. He is thinking that whenever I have to buy goods, I have to pay tax. But don't try to exploit his innocence. So when you are issuing an invoice to him, you inform him. What shall we inform? That I as a supplier am a composition taxable person. And because I am composition taxable person, I am not eligible to take any tax from you. So whatever I am selling to you, that price, I should not levy any tax from you. So this word should be reflected, okay, on bill of supply, Next important word is, tomorrow the team might be coming to inspect you. Your place of business should have an identification that you're a composition taxable person. So they are insisting that on the signboard that you're using, or the name board that you're using at your place of business, should also mention that you're a composition taxable person. Dealer shall mention the words composition taxable person on every signboard at his place of business. So you need to mention signboard at your place of business. It should be mentioned that you are a composition taxable person. Everybody who's coming to do business with you, or the department is coming to check you, they should know that you are a composition person. So you need to mention that. And then coming to your returns. Okay, your returns, you will be filing returns which are quarterly. Okay, the law is saying by 18th after the end of quarter. Once the quarter is end, you have to file it by 18th. Now you will get a doubt where this 18th came from. The regular people are filing their returns on 20 of next month. See, or close to the 20, 19 and 20, the server will be very busy. So with the regular people, if you also push the composition fellows, that server will not be able to handle so much traffic. So let the regular people file their returns by 20 of next month. You do it by 18th. Once the quarter is over, within 18 days you file. To reduce the pressure on the server, we have put this 18th. But you won't believe, for the first quarter, July, August, September, for quarter 1, July, August, September, as per the latest news, they have extended the time up to 24th December to file the returns. For that first quarter, they have extended time up to 24th December because it's the first year, nobody is ready for GST. The law is saying within 18 days from the end of the quarter, but who was ready to give it within 18 days? So that's why the first quarter itself they have submitted by 24th December. The time got extended like that. Then you will get doubt. We have to do all this in returns chapter. What is the name of that? GSTR 4 and GSTR 4A. This is the returns that we have to give. Okay, 4 is for outward supply, 4A is for inward supply. For your outward supply, you have to give 4, and for your inward supply, you have to give 4A. So this is another point which I wanted to stress on in composition scheme. Coming to the last discussion of a composition scheme, some additional points, because as I told you, this is a category A topic. You should not leave any scope of learning. You should be aware of all the points on composition scheme. No matter what question comes, whether it is a theory question or a practical question, you should be ready to face it. So just the last discussion. We said the scheme is optional scheme. So intimation of opting for composition levy. Okay, by a person applying for registration, a new SSC, by a person who is already registered. So two kinds of people. So I told you this scheme is open for new SSCs. At the time of registration, you can make an application that I want to go with composition scheme. Or if you're already registered but you're a small fellow, you've not touched huge numbers, your turnovers are less than 75 lakhs, you can opt for it. So how do you do it? This person may opt to pay tax, under composition levy. How do you opt? In part B of registration form 01. Such intimation will be considered only after grant of registration. composition will be effective from the date on which registration is effective. Okay, from the date on which registration is effective. This is an important point you need to remember. So what they are saying, when you are applying for registration, use one part B of your REG1. REG01 is registration form. You intimate that you are interested in composition scheme. Once they have registered you, they will consider your intimation, and such a composition scheme will be effective from the date on which your registration is effective. But if you are a person who is already registered, such person shall file the intimation electronically. Okay, everything is electronically. You don't have to visit the department. In the prescribed form on the common portal. When shall we file this application? Prior to the commencement of financial year. Okay. You should also submit a statement of input tax credit, and they are saying one intimation is intimation for all places of business registered against same PAN. Okay, so what does this mean? A supplier turnover is less than 75 lakhs, but he is operating intra-state supply from 4 states. Mobile business in one state, okay, garment business in one state, a shop, a small restaurant. So 4 activities from 4 states. So against his PAN, he has registration in 4 states, 4 places of business, 4 verticals are registered. And overall turnover of all the states has never crossed 75 lakhs. So he is opting for composition scheme. Okay, now the question is whether he should make an application state-wise. Okay, AP, Telangana, Tamil Nadu, every time, because in each state he is registered. So is he supposed to intimate state-wise that I want composition scheme, Answer is no. Okay, in this era where everything is computerized, we should avoid duplication of work. So we are saying in one state you give us an application, an intimation, and once you have intimated, it means that intimation is also on behalf of all the other registrations. So we don't want every state you need to submit. One state you submit, it is enough. That will take care of all the other places of business. So by this we finished learning section 10. Let us have a quick recap. It has got 5 subsections in it. 10.1 is briefly telling us the eligibility in terms of aggregate turnover. Okay, then we have to understand what is aggregate turnover. Then 10.2 is talking about who is not eligible, a list of people. Okay, 10.3 is talking about when is the option lapsing, whenever you cross the turnover. 10.4 is saying don't take ITC. 10.5 is telling if you did some fraud, then in that case we will apply penalty under 73-74 on you and we will cancel your composition scheme. So this theory that we have discussed, here and there some points have come from rules also, but you don't have to take the stress of quoting the rule. Rather, you should never forget the main section. Composition levy is section 10 with 5 subsections in it. This is enough. And we have heard each and every word from ICAR. So ICAR study material, whatever points they have mentioned for composition levy, everything has been replicated for you on the board. So you don't have to take stress of going back and referring to it. So we will just do some practical questions on composition scheme and wind up this discussion. Welcome dear students. Let us quickly do some practical case studies on composition scheme. Now that we finished learning the theory, it is time for us to test some practical questions. Yeah, there is an equal possibility you may either get a theory question or you may get a practical question in exam. So it's always good to be prepared for both. Okay, so let us see now what we have to discuss. See, look at this now. I have 3 examples for you on the board. Let's try to answer. The first question is, in the year 1718, there is a dealer. He's got the following breakup. His turnover is amounting to 77 lakh 60,000. This is what he calculated. It is a manufacturing concern and they are asking us whether it is eligible for composition scheme in the year 1819. Okay, because we need to check preceding year turnover. In the preceding year, if the aggregate turnover does not exceed 75 lakhs, then in the current year you are eligible for composition scheme. Okay, so this is the concept. Now, how do we calculate aggregate turnover? If you remember, we said it includes all the exempt supplies, it includes all the taxable supplies, it includes exports, it includes interstate supply, but it is excluding any inward supply, because this concept of turnover is from your outward supply point of view and it is not asking your liability on inward supply. So, if you have inward supplies, you may be liable for GST, but that inward supply is your expenditure, it is not your turnover. We are not supposed to take that. So, if we have to look at 77.6, there is something wrong with it. So, let's see. Intrastate supply, forward charge mechanism, yes. Nil rate, yes. Exempt, yes. Okay, goods are of different types. Taxable goods, non-GST goods, GST goods, goods which are subject to nil rate of tax, goods which are exempt by way of a notification. Okay, or inward supply, this we are not supposed to take, this we are not supposed to take. So, if you take the first 3, then it is coming to 75 lakhs, as it is not exceeding. So, here you have to go by concept of aggregate turnover. Aggregate turnover excludes inward supply. So, therefore, aggregate turnover is 75 lakhs, which is not exceeding. So, therefore, eligible for composition scheme. So, this was a test on what do you mean by aggregate turnover. Now, look at the next example. Here they are asking us to do 2 things: computation of tax liability under composition scheme and total tax liability. Okay, this problem has already given that the preceding financial year turnover was 68 lakhs. So, that means it is not more than 75 lakhs. So, therefore, the person is eligible for composition scheme and it is a manufacturing concern. Why this is needed? Because we know the rate of tax for a manufacturing concern is 2%, for a trader it is 1%, for a restaurant it is 5%. I am talking about total C and S, CGST, SGST. However, recently they have reduced, even the manufacturer is on par with the trader. For manufacturer also 1% rate will apply. So, now in this case, this is the breakup of the activity done during the year. Intrastate goods. So, first of all, in the current year also, you are eligible for composition scheme only up to the turnover of 75 lakhs. Once it is crossing 75, okay, reverse charge we are not going to take. So, it is coming to how much? This is 30 plus 18 lakhs is 48. 48 lakhs plus 2.4. So, that is 50 lakhs 40,000, and then you have interstate supply of goods which are chargeable at 18%. So, I will come back to this problem. I have done a small correction here. This I have made it 15 and 15 because end of the day, this problem is not testing us on eligibility, rather it is testing our computation of liability and the composition scheme. So, how do you compute? So, look at this, my dear students. Here, if you see the breakup of the activity, the person is selling good X which is taxable at 5%, selling goods which are nil rate, selling goods which are exempt, having some inward supply which is taxable under RCM, and intrastate supply of goods Y which is taxable at 18%. So, in this problem, the person is into local supply, point number 1. He is dealing into 4 different types of goods. X, Y, X is at 5%, Y is at 18%. Nil rated goods, exempt goods, so many variety of goods are there. So first important thing, we should not do any classification. No need of classification. Classification is not needed. Okay, this is point number 1. Then second important point you have to understand, check aggregate turnover of current year. What is the aggregate turnover of current year? And that aggregate turnover includes both exempt, nil, everything. It includes everything. So we have to keep adding this and this. So aggregate turnover is coming to 15 plus 15, 30 lakhs, 30 plus 18, 48 lakhs, and plus 2.4, that is coming to, okay, 48, and that is 50. 50 lakhs 40,000. Okay, 50 lakhs 40,000. This is the size of current year turnover. Aggregate turnover for the current year is subject to composition rate of tax, because this is a manufacturer and I am going with the rate which is there in your study material, but we know it got amended. They have recommended it to be 1%. May attempt students, go by your book, look at your RTP. So let's do 2%. So 2% of this entire thing will be your GST liability under composition scheme. But we cannot stop there. To this further we have to add, the person has got inward supply 5 lakhs, and we have learned that section 10 subsection 1 is saying, notwithstanding anything contained in this act. That means that this composition scheme is overriding the entire act, but subject to 9.3 and 9.4. So if this is a case of 9.3, okay, we have to apply the respective rate of 5%. So we should take 5% of 5 lakhs. So total GST liability will be your composition tax, which is 2% of aggregate turnover, and it is 5% of your 5 lakhs, which is with respect to reverse charge mechanism, inward supply. Okay, so this one will not enjoy 2% concession rate. This has to be taxed at regular rates itself. That's why we have taken 5%. The act is saying subject to 9.3. That means 9.3, 9.4 will override section 10. So regular rate will apply. Okay, and in this aggregate turnover, exempt turnover is also getting taxed. They are not saying 2% of taxable turnover. Rather, they are saying it is of that total turnover. But again, there is an amendment for the traders which came recently. They are saying we will take the rate on taxable turnover. Exempt goods they don't want to tax. So that's a recommendation in the latest council meeting. We have another example here. There is one SSE who is selling ready-made garments in one state, Rajasthan, local supply. And in another state, they are selling auto components in Gujarat. So two different states, they have been registered. In respective states, they are doing local supply. But what is the intention of the dealer? The dealer is asking, in one state, I want to go with composition scheme, and in another state, I want to go with regular taxes. Can he do so? What is the answer? We have studied one point here. When you are operating from multiple states, okay, and you are registered in many states, across the country, all the registered persons have to opt for composition scheme. If you are opting for one state, it means it is by default for all the other states. Okay, that's why this is an optional scheme. If you are not liking it, you don't come it. But when you come to it, come in total, not in parts. Don't say one state I will go with composition scheme, another state I will go with the regular scheme. That is not possible. You have to come into the scheme in total. So all the registered persons across the country on pan-India basis, okay, you are having the same PAN, then in that case this composition scheme will apply for all the units and not just for one unit. Okay, another example. Okay, option for composition scheme. I'll read it out for you. Look at the question. XYZ Limited, a manufacturing concern, had effected intrastate supply of 20 lakhs, local supply, and interstate supply of 25 lakhs. So they have local supply and interstate supply. The question is, can they opt for composition scheme under section 10? What do you think should be the answer? we have studied under section 10 subsection 2 ineligible persons. A person making interstate supply is not eligible for composition scheme. So therefore this scheme will not apply. Okay, if you are doing interstate supply, this scheme is not applicable for you. So this was our discussion on composition scheme. Hope you have enjoyed. Thank you so much.